Well, hello, everyone, and welcome. Cynthia Tomaine here with Interactive Brokers, and thank you for joining today's webinar on the VSTOXX futures and understanding and using Europe's VIX. Now, we're very pleased to have with us this afternoon Tariq Dennison with GFM Asset Management, and also Chichao Feng, who is Vice President of Sales for Asia for Eurex. So with that, what I'm going to do is actually let me pass the controls over to Tariq so that we can get underway here today. Thanks for joining us, Tariq. I'm going to give you the controls. If you can share your desktop, let's get underway here this afternoon. Thank you.
Now, do you see my title slide there?
We see it. Oh, there. Now it's in full screen. Excellent. Take it away.
Well, thank you very much, Cynthia and Guillaume. I'm very pleased to be back, and very glad to actually have Chichao right here in the room with me. So I'm going to be handing off to him a little bit later today. So as I hopefully described in this title slide, today we are going to be talking about the VSTOXX, and this is a 101 on the VSTOXX. What is this index? You sometimes hear of it called the fear gauge. You sometimes hear it called Europe's VIX. So I'm going to really just be describing the 101 of what is this index? Why do we care to trade it? Why do we care to watch it? How do the futures contracts on it work? And what are some actionable strategies that you can take away and actually implement in your Interactive Brokers account to trade this index? Now, as with all of my presentations, I start with an important disclaimer. And we have a disclaimer by Eurex. Okay, now a brief introduction about me. As mentioned, my name is Tariq Dennison. I am a Hong Kong certified financial planner and Hong Kong-based asset manager and investment advisor, also a trust and estate practitioner. If you find my firm on the Interactive Brokers platform, you will notice that we are one of the advisors that is set up to manage your investment account on the Interactive Brokers platform. If your account is in Hong Kong or Macau, our advisor handle is GFM Group Limited. And if it's outside of Hong Kong and Macau, but elsewhere in the US, mainland China, Taiwan, or a number of other places, we manage it out of the US from our US registered entity, GFM Asset Management LLC. Please contact me or visit our website for more disclosures and details there. Now, about my own background, I've been in the market since 1998. So quite familiar with many different instruments, currencies, equity markets around the world. My own Wall Street career has been on the sell side for a good chunk of that time. First with the German bank Commerzbank in New York, London, and Frankfurt, then at Bear Stearns, then JP Morgan. I came out here to Asia 10.5 years ago with CIBC, where I first worked in Toronto and London before coming out here. Then I spent 1 year at Societe Generale, also here in Hong Kong, before starting my own buy-side firm. Basically figuring I had enough time on the sell side, it was good for me to get into directly managing the end client's account on platforms like Interactive Brokers. From an education point of view, I have a master's in financial engineering from the University of California at Berkeley. And where that's especially interesting to today's presentation is I actually did my master's thesis on volatility trading. So this is a topic that is actually quite, near and dear to, that I have a background in going quite a long ways. So hopefully I'll be able to explain it just as clearly as I first understood it back when I did my master's thesis. I do also teach 2 Masters in Finance courses at the ESSEC Business School in Singapore. My main focus is on the US-Asia corridor. So as you can guess, as an American with a US advisory firm based in Asia, I help Americans invest in Asia, Asians invest in the US. You may wonder why I'm here talking about Europe. There's another story that I actually, I can actually tell you about at another time. But here we're going to be talking about the VSTOXX index, which is a good liquid index on one of the most liquid equity benchmarks in the world. As mentioned, my book is titled Invest Outside the Box. There's a picture of it on the lower right-hand corner in case you want to look it up on Amazon or wherever you get your hard copy or digital books. Now, the 2 parts of my presentation today. First of all, I'm going to be talking about what is this VSTOXX. I'm going to be starting with a very, very basic introduction or a refresher on what options are and what implied volatility, really what does it mean when we talk about measuring volatility, and what does it mean in terms of it being a measure of fear. And from going from options and the implied volatility of options, what is the VSTOXX index? I say it's Europe's VIX and the definition of one or the other, but I actually find many even professional advisors I speak to, when I ask them, define how the VSTOXX is calculated, many of them have actually never read the white paper. So I'm going to try my best to explain in plain English terms in a few slides with pictures how the VSTOXX works and how you can follow when it goes up or down. I'm going to show you some historic charts of how the VSTOXX index has moved up and down, but just as importantly, how the VSTOXX futures have moved quite differently than the index. Because the last thing you want to do is to say you thought the VSTOXX was going to go up, and then you find your futures contracts haven't gone up and you haven't made any money or even lost money. That's going to be something which I hope to make clear when I explain the difference between the index and the futures contract in today's slides. I'm also going to be talking about some differences between short-term tactical trading strategies and some more long-term, what are called premium strategies. And I'm going to try and describe each of those and how you might use them as part of an overall investment strategy. Now, when we get down into the mechanics, what I often call the right side of my title slide pages, I'm going to show some sample VSTOXX futures trades in an Interactive Brokers account. So that's going to show you the ticker, that's going to show you how to enter the trade, it's going to show you the margin limits for a long and a short position, which are actually different in this case. So we're going to talk a little bit about margin limits, and that's going to be about the time that I'm going to hand over to Chi, and he's going to tell you a little bit more from a Eurex point of view, things about contract specs, margin limits, and other things you're going to want to know specifically about this contract. Now, even though today's topic is on the VSTOXX index and VSTOXX futures, I do want to mention, for those of you who want to skip ahead and get excited about it, yes, there are options on the VSTOXX as well. I will have one slide later that just shows you what that looks like, and that will be another topic as well when we get to talk about VSTOXX option strategies. Chi will also be mentioning a little bit about trading hours. Like many futures contracts you may see, you can trade these 20 hours a day, so it would be a good contract for you to consider if you wanted to trade it versus the VIX during US hours, or even want to trade before the Euro STOXX opens, before Europe starts in Asian hours. So big background. I've noticed here I say long-term history of the VIX index, but to be fair, this is about the VSTOXX index as well. Let's say that you're not a volatility trader, you don't like math, even options kind of seem a little bit exotic for you. You may wonder, why do you care about this index? And it goes back to one of the main sayings you may have heard of in investment from Warren Buffett, where he said, I will tell you how to become rich. Close the doors, be fearful when others are greedy, and be greedy when others are fearful. So that is one of the simplest things we've always heard about investments, but how to be a good investor. But that leaves us with one big question mark. So how do you know when others are fearful? I've been asked 3 times this week already, do I think the markets are overvalued? Do I think that markets are getting too complacent or that there's more room to fall? Well, we want to look at a benchmark. We want a thermometer of whether the market is too hot, or maybe the market is too panicked, too oversold, too fearful. What is that index? And that is why indexes like the VIX and the VSTOXX get called the fear index, or the fear gauge. So let's go into what is the VSTOXX and why is it called a fear gauge. So first of all, I mentioned that I want to start off with a quick 101, a quick refresher, a quick review on what options are and what the options markets are. Now, some of you may be very familiar with options. Please bear with me as I introduce anyone who might be new to options. Options basically are a way for you to slice up moves of a stock or of a market benchmark to very, very fine levels. You can think of it as a market, as a very fine-tuned market for fear and greed. Now, if you look at this particular chart, this chart, what it shows on the tab highlighted, options expiring on December 18th, 2020. That was 35 days from when I took the screenshot for the Euro STOXX 50 index. Now, what it means, you see on the left we have call options, and on the right we have put options. Call options are what makes money if the index goes up. Put options are what makes money if the index goes down. Now, you'll notice when I took this screenshot, the index all the way at the upper right was 3,445. Let's say, for example, I wanted to make money. I wanted to get all the upside of the index going up from there, but I didn't want to take any risk of it going down. If you go right down the middle, right down that blue strike column, down to where it says 34.50, you will notice the prices of those contracts on the left. If you go left from there to the calls column, 80 spot 10 at 81 spot 40. That is basically the price to buy all the upside from 34.50, and if the index is below 34.50, all you lose is you lose those 80 euros. So you limit your downside, but you can get all the upside. The same exact thing on the other side. If I want to bet that the index is going to go down, I go right from 34.50 and I see 87.5 at 89. If I pay 89 euros, I can get every point that the index finishes below 34.50, and if it finishes at or above 34.50, all I lose is my 89 euros. So as you can see here, when we slice it up, and I'm going to have some more examples, we have a measure of fear versus greed. Now, if you look at the implied column, that's right next to the delta column, that is a measure of how much the market is expected to move over a given year. Now, don't worry, for those of you who are old hat to options, you knew all this already. For those of you who are brand new to options, this may seem like a really fast crash course. I'm trying my best to balance. I'm going to go into a few more examples next. So options in a nutshell. Call options give you all of the upside above whatever that strike price is for a fixed premium. So let's say, for example, if you have a $10,000 car and you want to buy protection against the car being completely destroyed, it'll cost you a certain amount. If you have a $1,000 deductible, so you only get protection from $9,000, but you eat the first $1,000 of losses, the premium is going to be cheaper. And in a way, it's the same sort of thing with options. You get to decide where you want your profits to start, and the further away it is, the less you have to pay for it. An option price is determined by 4 factors. You will hear of a formula called the Black-Scholes formula, where the price of an option is determined by what is the current price of the index, what is the strike price of the option, how far out is the option, is it 1 month, 3 months, 6 months, what are interest rates, and what is volatility. That last factor there, what is volatility, is what really drives the price of options. Obviously, buying an option on something that doesn't move is going to be much, much cheaper than buying an option on something that moves a lot. And so when you saw in that column there, 17%, 25%, that is a measure of how much the market expects the Euro STOXX index to move. Now, one thing you might also hear from option traders is something called the Greeks. Now again, those of you familiar with options already know these Greeks. To those of you who are brand new, I just want to quickly introduce what those columns, delta, theta, vega, and so on, you might have seen are. Delta refers to the change in the price of an option versus the change in the index level. In other words, if the index goes up 100 points and your option goes up 25 points, that option is said to have a 25 delta of 0.25. And if the option goes up 50 points for every 100 points the index goes up, that's a 50 delta option. So the closer the option is to the money, the closer the option will be to 50 delta. The further away it is, the closer the option delta gets to 0. The other thing we often look at when we buy options is something called theta. Theta also means time decay. You know that if you buy an option, if I bought the options I told you earlier, if the index doesn't move, it just stays there for 30 days, the 88 euros of premium that I paid for the option would just eventually fade away. Just like if you buy an insurance policy and nothing happens, you eventually lose your premium. Every day that time goes by and nothing happens, options get less and less valuable. So that's another factor you want to look at, and we're going to see this a little bit when we look at the VIX index versus the VIX futures. The factor that you want to look at when you look at VIX futures versus trading options is something called vega. Vega is if the implied volatility of the option, let's say if we expect in an average year the Euro STOXX is going to move by 20%, and now we expect it to move by 21%, how much will the price of an option move? That difference is vega. It's not related to the movement of the index. It's not related to a change in time. It's related to a change in the market's expectation of how much, in either direction, the index will move over the course of a year. That is the implied volatility we're talking about. That's the level of fear. When people are afraid, we expect the index to move a lot and we're not sure which way. When we're not afraid, we just don't expect the index to move that much. Now, there are dozens of option strategies, and I could do a whole separate webinar just on option strategies. But what we're talking about here is purely about trading volatility, whether we expect that level of fear to go up or down. Now, a sample trade, just to give an example of put options again, earlier I showed the example of the Euro STOXX 50 being at 34.55. And in the case I gave earlier, we could pay a premium of 327 euros in order to receive 10 euros per point if the index is below 32.50 on December 18th. If we go back to that sheet I showed you earlier, if we look down that column, we saw 32.50. If we looked over, we would have seen that price 32.7. Euro STOXX futures, Euro STOXX options are 10 euros per point. That means that if the index finished at, let's say, 3,000, then I would get 2,500 euros. If it finished anywhere above 32.50, if it stayed the same, even if it went down a little bit, I would lose my 327 euros. If you looked across at that implied volatility portion, that implied volatility number was 24.2. It meant that when the model was used to plug that option traders were assuming the Euro STOXX would move on average up or down about 24% per year on an annualized basis. Yes, there's technically a slightly different mathematical definition, but an index that can move up or down 24% a year is less volatile than one that can only move up or down 10% a year, and less volatile than one that can move up or down 50% per year. We're going to see how much that VIX index moves. Now here is colorful, showing you in green what your profit would be on this option trade, and in red what your loss would be on the option trade based on the final value of the index. Again, this would be more detailed in an option trading webinar. For now, I want to focus on that volatility number, on that 24.2. Now, a few things to remember about implied volatility. For a call and put option of the same expiry and strike, the implied volatility must match. That's called put-call parity. If it's not, then you've got an arbitrage strategy there. But for the same expiry for different strikes, you'll notice that implied volatilities don't have to be the same. If you go back to my earlier slide where I show those option quotes, you'll notice that the lower strike prices had a higher implied volatility. The reason for this is that markets tend to get more volatile when they go down than when they go up. And we saw this in March when the markets were crashing, volatility went up because people got more and more afraid, and they were more and more willing to pay to buy insurance against further and further crash protection. Now, what we also see is there is a term structure. So if you look at 1 month options versus 3 months options, implied volatilities for the same strike can be different as well. But for now, the thing to remember about the VSTOXX is the VSTOXX is centered around a 30-day maturity. So the option portfolio we're going to measure there are for the options maturing before and after a 30-day window. We're going to look at that next. So when you look at a VSTOXX calculation, now compared with, say, the Euro STOXX itself, where I would show you the 50 stocks, or let's say the Hang Seng Index, where I would show you the 50 stocks, the VSTOXX index is an index of options. And the weight of the portfolio of options here is one that you can get on the STOXX website, on this particular website, on any given day. It will show you the maturities and strike prices of all the options used and what their respective weights are. Now, you may wonder, how on earth did they get this? Is this arbitrary? No, it is not arbitrary. On the left, I give you the link to a paper written by Emmanuel Derman and a few of his colleagues at Goldman Sachs back in the late 1990s. The title of the paper was More Than You Ever Wanted to Know About Volatility Swaps, but less that can be said. It basically described how you could perfectly replicate the volatility of any instrument by creating what is called a log contract, buying a series of options that create a payout proportional to the logarithm of the final value of the index, and then delta hedging it. That's where you get all of these weights. These weights are effectively the weights of options needed to make this curve on the left. And when you do that, whether the index goes up or down, then you will have more or less replicated the realized volatility of the index at the time. Now remember, the VSTOXX is not an implied versus realized trade. It is always implied volatility. So when you trade the VSTOXX futures, You are trading the current expectation of implied volatility versus what implied volatility becomes a little bit later when you get out of your index. And we're going to be showing that again through a few different examples. Now, for those of you who like math, now I'm guessing about 3/4 of you will kind of roll your eyes at this point and say, oh my gosh, calculus, integrals, don't worry about that. For those of you who like math, please enjoy this slide. There are 2 clips from the Emanuel Derman paper, which I think gives you the idea of how weighting options that way give you exactly the smooth vega that you're looking for all along. For those of you who don't like math, don't worry, the weighting scheme works. We've been doing it for decades. So that, in a nutshell, is the definition of what the VSTOXX index is, what the index components are, how they're weighted, and how they're calculated. Now let's go ahead and dive in to the VSTOXX futures contracts themselves. You will see what I have here. I have a screenshot of several contracts and indices on my Interactive Brokers trading screen. At the top, I've got the Euro STOXX 50 index and the Euro STOXX 50 front month futures contracts. Now again, that's just if I want to trade the index itself or kind of see how it's moving. Now below that, I have the VSTOXX index, the V2TX index, and then the next few futures contracts. And the reason I have the next few futures contracts is I want to have some flexibility on whether I'm going to trade the front month, the second month, the third month, and so on. Now you'll notice the later months don't have quite the same amount of volume as the front month. There is a lot more liquidity in the front month. But I do have some choice and I do have some term structure, especially in this case over whether I want to trade the December or the January. Now what I'm betting on here, I am buying futures contracts on what the VIX index is going to be when that futures contract expires. Remember, these are cash-settled futures contracts, and right now, these contracts are what futures traders are going to say, backwardation, contango. The December futures contract is trading below the current spot level of the index. That means the market is expecting the VSTOXX index to decline from when I took this screenshot until December 16th. And if you disagree, if you believe it's going to be higher than 2235, buy the contract. If you believe it's going to be lower, then sell the contract. Let's look at a few historical scenarios and see how that strategy would have worked in the past. Now, first of all, let's take a look at what the VSTOXX index has been historically. It looks, certainly compared to any stock index, like a really, really wild ride. But the nice thing is you can pretty well match up to any of the points where the VSTOXX got up to 40, 50. Those were clearly times that the market was fearful. And in general, if you bought into the market, if you didn't buy the VIX, but VIX or the VSTOXX, if you bought the Euro STOXX, if you bought stocks when the VSTOXX index was that high, you usually did fairly well. On the other hand, when the VSTOXX index got really, really low, say in periods where it was below 15, usually that was a sign that the market was relatively complacent. That didn't mean that it didn't keep churning higher, but it meant the market was not afraid. So if you want at least a quick finger in the air measure of whether the markets are greedy or fearful, this is one of the ways of reading it. This is a quick and dirty measure of high VSTOXX, market is fearful. Low VSTOXX, market is greedy. So for this, I wanted to look at a few different periods. I wanted a few different years in a row. So I wanted to say March 2017, March 2018. Let's say, for example, in each of these previous years, we wanted to do one simple strategy. So let's say all the way back, let's say in August of 2016, I wanted to sell the March 2017 VSTOXX contract and just hold it until maturity. And I'm going to do this in 2017, 2018, 2019 to just show you how that particular strategy worked differently each time. Now for this first one here, I would call this, even though it would require some patience, a VSTOXX seller's dream. If you start all the way back in August of 2016, the VSTOXX index was only about 18 or 19, but the VSTOXX futures was trading at 24. So clearly there was some premium, there was some expectation that the VSTOXX would rise, some risk premium there. So if you sold it at 24, you would have waited several months. You would have waited all the way to December, and your contract would have stayed right around 24 the whole time. Now that was despite the fact that the blue line, the actual VSTOXX index, swung up and down, above 20, down back to 16, all the way up to 25. It got above actually the levels of the futures. but that futures contract really didn't move very much. Then at the turn of the year, so in December, January, February, you notice that the VSTOXX index came down a little bit and the futures contracts started coming down and converging to it. Now, this is pretty typical. It happens a lot of the time, but not all the time. If you did this regularly, you might expect some kind of premium return from selling and rolling VSTOXX futures, but don't count on it. I'm going to show you some times when it didn't work and it would have blown up spectacularly and lost you a lot of money. Here's scenario number 2. This was the scenario we called Volmageddon in some cases. This was when a lot of vol sellers looked at that 2017 scenario and said, this is easy. I'm just going to sell VSTOXX contracts and just collect that premium and let it ride in. Well, if you did that back in August of 2017, you rode that in. And in fact, it looked like this was working better for you even more quickly, because you would have sold the contract just above 20 and it would have glided down to about 15. You would have made hundreds of euros pretty quickly. But then what happened? All of a sudden, late January, February, bam, wow. All of a sudden, the VSTOXX index exploded, went up to 30, 35. Now note, we were looking, the brown line is the March 2018 VSTOXX contract. It did not go all the way up to 30, 35. It did go up, certainly if you still held it short at 15 and it suddenly went up to 22, it would have hurt. You would have lost money, but not as much as if you, let's say, had held the February contract, which had to converge much more closely. Now you'll notice for the rest of the period, the VSTOXX contract then was trading at a discount. It was trading slightly below the cash level of the index. And then of course it eventually converged again in March. That was 2018. Now let's look at 2019. 2019 was arguably one of the least satisfying years to be a VSTOXX contract seller. Because along here, okay, initially you sold it pretty darn close to where the index was. And during the course of the year, you saw the VSTOXX index going up and down and up and down and right around your contract. And your contract really didn't move. It stayed below or above it. And yeah, it eventually converged. But if you did this trade, chances are for this 7-month period, you didn't make any money and you took a lot of risk. So this is one of the downsides where you might not make money, but it's also quite an unsatisfying trade. Something to watch out for. Again, the difference between being a long-term premium trader and a short-term tactical trader. Now, the chart which I'm sure many of you were waiting for and getting really excited about is how did the VSTOXX trade work this year? And this is one of the years that VSTOXX traders lived for. Especially if you timed it just right. If you were watching early in January, February, you're like, my gosh, this makes no sense. The market is being so complacent. We need to buy some insurance. Somebody is going to panic. If you bought VSTOXX futures contracts around 15 in February and then the market panicked, you did really well. But watch out here. Look at all these contracts down here and note the difference between the March 2020. So the green one, H stands for March, M stands for June, U stands for September, Z stands for December. The March 2020 contract is the only one that sent you from 50 to 85 in a really short time horizon, because that contract just happened to expire right when the VSTOXX cash index was at its high around 85. If you were short that contract, you would have gotten crushed. You would have lost multiples of whatever you thought the contract volume was. But if you held longer term contracts, you'll notice, for example, the June and the September contract spiked, but they spiked nowhere near as much as the March contract. Again, interpret that as an expectation that there was going to be mean reversion, that there was going to be this fear, but eventually the VSTOXX level was going to come back down. And you see, again, how the cash level of the index and how the futures more or less converged for the rest of the year. I highly encourage anyone who wants to trade VSTOXX futures to study these charts I've provided here as a sample, because they provide a very important history lesson on what can go right, but also what can go spectacularly wrong. Now, in terms of what is that premium strategy, how does it more or less work? There have been several strategies, several indices, which have more or less tried to track what's the strategy of if we want to have a permanent position in the VSTOXX. Here was an ETN, an exchange traded note issued by IPATH, which really just tried to do a very simple strategy. It would just buy the short-term VSTOXX futures contracts and roll it every month. Very simple strategy. And if you invested in this strategy back when it launched in around 2010, you would have lost 98% of your money. Now, that probably gives you a clue that taking the other side of that trade, selling and rolling short-term VSTOXX, other than the occasional blowups, would probably be a pretty good strategy. You can see times when buying this would have made a lot of money very quickly. It gives you really an idea of what the risk return is and where the return premium more or less comes from. So this again is one thing. I'm just going to go ahead and leave it here. Please study it and look at it if you're considering trading these futures contracts. Now, on the specific example of an Interactive Brokers trade, if you type this in, so here in this example, I was going into an account that was based in US dollars. I wanted to say, let me buy a January contract, let me sell a January contract. You'll notice that the limit prices I'm putting in here are kind of outside the bid offer range. I wasn't doing this to get filled. I just kind of wanted to show you what the contract size was. So here what you're talking about is you're talking about a contract with relatively small size. So even if you buy this, like let's say if I bought it at 23 and the VSTOXX went down to 18, I'd lose 500 euros, not enormous amounts of money. So it is in a way, small trader friendly, allows you to trade small sizes. But that again is because this thing can really move. If you are, let's say, a small trader and you're selling this at 23, selling it at 23, hoping to make 100 euros here, 100 euros there, and the index goes back up to 80, you can lose thousands of euros very, very quickly. So consider it like picking up nickels in front of a steamroller. Really make sure you watch that risk return. That is also, of course, why you see the margin requirement for selling the contract as higher than the margin requirement for buying the contract. You buy the contract, in theory, the VSTOXX could go to zero. I don't see how volatility could actually go to zero, whereas volatility can, of course, rise a lot more than 100%. So strategy number one, what are some of the strategies we're going to talk about? Well, one strategy is just being a permanent VSTOXX seller, meaning that you're always going to go out and have a permanent, regular rolling short position to collect that forward fear premium. Now, again, you might not want to do this with the front month. You might want to do that with the contract 3 months out and then roll down to 2 months and then roll it again, or sell the contract 6 months out and then buy it back at 3 months, roll it that part out. The whole idea there is you're collecting premium. You're collecting the expectation that people think volatility is going to be higher in the future. They're worried, and you're selling into that fear. So on average, just like you saw with the iPath, in most years you could collect a decent premium. Every now and then you can get walloped. This is another benchmark. This is called the VSTOXX Short-Term Futures Inverse Investable Index. This is another rough measure going back to 2009 of what the performance of that strategy would be. Again, if this is something you're considering, I highly recommend going to the link I provided below, studying this index, study how it works, and make sure you understand the strategy before you put real money on the line. Strategy number two. So the first strategy I mentioned, because I'm a long-term investor, was one that was a little more permanent. The other one is a little bit more tactical, is if you're a timely buyer. That was the example that I gave you back in February. If you had the foresight to say, you know what, this is crazy. People out here are not wearing masks. There's no protection against people coming from, China having to quarantine. If you saw that and you bought the March VSTOXX futures, you would have done phenomenally. And the same thing too, whenever you find the VSTOXX level getting a little bit too low, you want to take some tactical trades. It's something where you're not going to be in it all the time, because having a permanent long position in VSTOXX, as we've seen, is very expensive. So this is something to consider if you want to consider tactical trading versus vice versa. Last but not least, the strategy I want to present is the one called the curve trader. Now, those of you who've done bond trades, who have done 2s, 10s, steepeners, flatteners, are quite familiar with this. You'll notice, for example, right now, if you look at the VSTOXX curve, it's remarkably flat. The December, the January, the June, all of those are pretty flat around 22. If you believe the curve is going to steepen, like let's say, for example, you believe the short term, maybe February is going to come down, but then the longer term index is going to stay where it is, you might want to do a steepener trade. On the other hand, you might want to consider an inversion trade. It's where you're going to buy 1 month, sell another month, and try and profit on changes in that VSTOXX futures curve. Again, that's a slightly more advanced strategy, but one that some of you may consider. Now, as I promised, I wanted to show you the screenshot. Yes, there are options on the VSTOXX index. Here they are for you. For those of you who already feel that you've mastered the VSTOXX and you're comfortable with options, please take a look at this. There will be another webinar on this if there is interest, but for now, I'll just go ahead and leave these here. Now, I'm going to go ahead and unplug my headphones and hand it over to Eurex's Chichao, who will tell you more.
Thank you very much, Tariq. Hi, everyone. My name is Chichao, and I'm very pleased today to give you some of the introduction on Eurex and some short updates on the VSTOXX future. So first of all, Eurex is owned by Deutsche Börse Group, which is a German-based exchange holding group in Europe. And under the exchange group, we have various business entities. So besides Eurex, is the marketplace for listed futures and options. We have EEX, European Energy Exchange, which offers the trading of electricity and emission of carbon dioxide. And there is Eurex Clearing, one of the leading clearing house in the world. So moving on Eurex, we offer a comprehensive product offering of futures and options. We have over 2,400 futures and options covering European equity index and fixed income market, as well as the major market around the globe. With this broad product offering, we currently have more than 350 exchange participants from over 30 countries, and we have over 8,000 registered trading on our platform. And one of the advantage for our clients to trade on Eurex exchange is that all our products are essentially cleared. That means the execution risk and counterparty risk are minimum, especially when clients trade in the Eurex T7 trade entry services. So currently, Eurex provides the extended trading hour for our benchmark futures, starting from 8:15 in the morning Hong Kong time. And the trading will continuously trade for 21 hours until 5 a.m. Next morning. So here, I would like to give you some introduction on the VSTOXX futures. Eurex offers these European Volatility Index futures to facilitate the trading and hedging for our clients using these alternative instruments. First, we look at the graph to the right. We have two lines here. So the dark one is the VSTOXX spot index, and the light one is the VSTOXX futures price. As you can see, as Tariq has just shared with everyone, the VSTOXX has spiked sharply in March this year. That means the serious worry and fear in the market against the impact of the COVID-19 to the economies. Also in the graph in the bar area, we have the liquidity of the contract. That means the number of traded contract of VSTOXX futures. As you can also see that during March this year, the contract was traded almost around over 200,000 to 300,000 contracts at some point per day. And over this year, on average, we have around 51,000 contracts traded per day. And looking at the table to the left, is the contract spec of VSTOXX futures. One thing I would like to highlight is the multiplier of VSTOXX is 100 euro. That makes the contract relatively small in its size. And on the Interactive Brokers website, we can easily check the margin requirement for VSTOXX futures. As I just checked yesterday, it's around 1,250 euro. And you may also notice that the trading hours of VSTOXX future is not shown here. And so we will continue and explain why is that. So since December 2018, Eurex has extended the trading hour of our benchmark futures, including Euro STOXX 50, DAX, mini DAX, and German government bond futures. So all these products will be available for trading starting at 8 a.m. in Hong Kong time. Moreover, we have all of our MSCI futures. We have listed over 136 MSCI futures product in the Asian Asian hour as well. And to support our clients trading, Eurex has implemented the full trading functionality in the sessions, including like trade entry services for the off-book trading and the exchange for physicals. In this slide, we will show the past 2 years development of the trading hour extension. As you can see to the left, with the spreads of each product is almost the same or identical to the spread during the core European hours. And next is the graph of the monthly volume of our trading hour extension. As you can see again that we have a growing volume since launch, and in March this year, as the market was extremely volatile, the high bar represent the historical volume traded, and that means in the market that there are both hedgers and traders keep constantly monitoring the market as well. So as the next step, as we call it, THX Phase 2, we will launch more products in the Asian hours, which will include VSTOXX futures and the other 3 products like STOXX Europe 600 futures, Euro STOXX Bank futures, and the 10-year Euro French OAT futures. So starting from next Monday, 7th of December, we will have all 4 products adding to the THX. Will be available for trading starting from 8 a.m. in the morning Hong Kong time. With that, that will conclude my presentation, and here you can find our contacts. So in case of any question and feedback, please feel free to reach us. Thank you.
Well, thank you, Tariq and Chichao, for the presentation here today. I also want to remind you, if you do have any questions, notice there is that questions panel. Enter those questions now and we'll handle them before we do part company here today. Now, I also do want to point out the handouts panel. Tariq mentioned the charts in his presentation, and you'll find the PDF is available for download in that handouts panel. And also, Eurex has provided a fact sheet on the VSTOXX derivatives. So there are 2 handouts there. You can simply download those before you do exit today's session. Also, before I do turn it over to for the questions here, want to remind you that today's webinar will be posted on the Interactive Brokers website. You'll find underneath the education menu, there's a webinars link, and simply choosing recorded versions and the industry sponsored tab, you'll be able to see or access today's recorded playback, as well as a copy of Tariq's webinar slides for today's presentation. So with that, I'm going to turn it back over to Tariq and Chichao to handle any questions that have come in. Over to you, gentlemen.
Excellent, thank you. I'm just going to plug in my headset. I see 3 questions here, and I think they're all Tariq questions. I didn't see a Chichao specific question. So the first question is, can I buy and hold V2TX for a few months? Well, short answer is yes. If you wanted to buy, let's say, the February futures contract, you could hold it until it expires. So I think with like any futures contract, whichever month that you buy, you can hold it up until the part it expires. But of course, if you want to hold it beyond that, you would need to roll into another one, and you would have whatever the roll cost is, the difference between, say, the February and the March future, or the February and the June. That's one thing to keep in mind, which is why I say, for those of you who have longer term strategies, you need to think about your rolls, about how you plan to get from one contract into the next. And I think this is related to my next question. Is there an equivalent of the VXX for the VSTOXX? So I actually have to admit, it's been a while since I've looked at VXX. I don't remember if that's the short or the long version. The iPath ETN, which I gave an example of, and I looked it up purely to find what returns were for rolling a VSTOXX strategy. That, I believe, is it. I mean, if you find ETNs like that pretty much track that strategy, that's what they do. They aren't always front and center on a lot of brokerage platforms because ETNs have their pluses and minuses. My own view And by the way, I see you have a second one. Is there an equivalent of the SVXY for the VSTOXX, which I believe is the short VIX version of the VSTOXX? Again, I believe if there is, I would probably start with the iPath ETNs that trade in Europe. The VSTOXX would have very much a European audience. I don't believe there would be a VSTOXX product traded in the US during US hours. They're busy enough dealing with the VIX. My own view, now again, not everybody agrees with me, is that if you understand volatility enough to trade any of these products, you may as well be trading the futures contracts. Because the problem with these ETFs, ETNs, is that they have a roll strategy in there that many people who buy or hold them forget about and may not know the effects of until they're too late. And if you follow everything that you've said here, my hope is that you find the futures contracts just a clearer and more direct way of trading the index, because after all these products are doing is they're trading the futures anyway. So that's, again, my view, but if you look up my name, you'll hear I've said the same thing about Bitcoin and many other things. If you can't be trading the futures, you probably shouldn't be trading the ETF that trades the futures. Next question, any trading tips or strategies, things to look at when trading the spread between VSTOXX and VIX? Well, certainly, actually. Now, as you may know, I'm a bit more of a fundamentalist. If you want to ask, for example, why is it that one index may go up and the other one might not, you really have to look at what might spawn fear in Europe but not the US, or vice versa. So let's take, for example, COVID-19, that outbreak in March, actually hit the world quite uniformly. I mean, it already hit China, so China was already hit. But Europe and the US were both hit at the same time. So both the VIX and the VSTOXX were hit at the same time. I don't know anyone who played that spread well. But on the other hand, if you look at, let's say, the US election last month, that was something that arguably hit the US more than it hit Europe. Same exact thing too. Let's say there's something specific on a Euro crisis basis. Let's say there's a European election or some other factor, or let's say another Wirecard scandal. Wirecard was a member of the Euro STOXX 50, not of the S&P 500. If you have a factor that affects one but not the other, then the VSTOXX and the VIX can diverge a little bit. Again, it's not for everyone, but the only way, or guys, I would say the only tip I would provide is learn those two indices, understand what the two indices are and what makes one more volatile than the other at any given time. So those are the questions I see so far. Are there any other questions?
Well, Tariq, what I'm going to do, and thank you, Thomas, for that question, I also do have a link to a previous webinar that was sponsored by Eurex on those spread trading strategies between the VIX and the VSTOXX. I've just posted that link into your questions panel, so if you want to copy that, it is available for review. Let me see, with I see another question from, one last question from Thomas there, Tariq.
Was that the one that I already answered? The chips trading strategies?
Should the VSTOXX naturally be lower than the VIX?
I didn't see that.
Because it has 50 stocks? Okay.
You just told me the question, so I can answer what you said. Well, short answer is no, not necessarily, because volatility is not determined so much by how many stocks there are in an index. It's really about what the stocks are in the index. Okay, there I go. I see it now. Should the VSTOXX be naturally lower than the VIX because it has 50 stocks in the index compared, well, it's actually 500 in the S&P 500, which is tracked by the VIX. Arguably, you would say that the S&P 500 should be more diversified and should be less volatile, arguably. But you also have to look at what's in it. Because if you look at the S&P 500, the top components are the FAMGA names, Facebook, Amazon, Microsoft, Google, which actually aren't that volatile. They're basically blue chips at that point. And you look at what are the main components in the Euro STOXX 50 by comparison. Okay, well, there are a few banks, a few consumer products companies, a few big industrials. They don't really have any FANG or big tech names in quite the same way. I mean, Delivery Hero, I think, was recently added. That's probably the most volatile names in the Euro STOXX 50. So it's not because there are only 50 stocks, but it's because what those stocks are. And that's the main thing, again, I would watch, is that if, let's say, for example, the top components in the S&P 500 become far less volatile, and let's say there's another Euro banking crisis, the VSTOXX would become probably sustainably higher than the VIX in a scenario like that. When did the VSTOXX start trading? Do you have a Bloomberg ticker for the VSTOXX index? I'll unplug in the.
Hi. The answer to the question is, so right now the VSTOXX is open on the 3 a.m. 3 p.m. Hong Kong time as the
No, I think he means historically. Was it 1999? Was it 2000?
Sorry. So I believe that VSTOXX futures. So the current one was started in 2009. So actually, I believe that's enough historical data for any strategies. And yeah.
And the Bloomberg ticker, is it V2TX or?
Yep.
In Bloomberg?
Yep. Yes. I believe also.
Also V2TX.
Yes.
Is the understanding there? So. Okay. So yeah, so that's the history, and that's why when I pulled it, yeah, V2TX. Yep, I think that was the question. I think the answer is yes, right? V2TX.
Yes.
Yep. We believe that's right.
Okay, well, with that, it looks like the questions, you've handled those questions. I want to thank Eurex for making today's presentation possible. Excellent job, gentlemen. Thank you very much. I also want to thank all of you for your participation with us here this afternoon. Keep in mind to access the recording for today's event. Simply go to the Interactive Brokers website. Underneath the education menu, you'll find a webinar section there where you can visit the recordings page and access today's recording and the webinar notes. By the way, if you do want a copy of today's presentation or the fact sheet on the VSTOXX products, simply go into the handouts panel and you can download from there. Well, with that, we are going to conclude our session here this afternoon. Thank you all for your participation as well. Have a great rest of your day, everyone. By the way, you can exit using the X in the upper right-hand corner of the screen. Thanks all.